Hello, everyone, and welcome again to a session of Role Model Rebels, the Tuesday sessions. Twice a month, we are running masterclasses, group coaching at Role Model Rebels. And for those who don't know yet, Role Model Rebels is a think tank of, in the meantime, nearly 2,000 women from 40 plus countries. And we deliver masterclasses and group coachings on hot digital topics, but also on topics like financing, like today, or on women's health. And for all those who would like to get more information, Andrea has put the links into the chat. And having said that, I would like to welcome for this afternoon session, Aysha Investing. Aysha has been working in real estate and private equity. She has been working with financial and advisory firms in Switzerland, in New York City, in the Netherlands, and in Dubai. Aysha is a single mom of 2 boys, and she's not a single mom. She decided to be a single mom. She lost her husband when she was pregnant with her second boy, which is also an important part in her whole story, why she started these courses on investing, learn basics of investing for women. She will tell us why it is so important that women not only save, but invest, and why it is so important that they just look after their own financial issues. And having said that, I think, Aysha, the floor is yours. Questions will be collected by Andrea. And at the end of Aysha's presentation, Aysha is going to answer these questions. Having said that, Aysha, the floor is yours.
All right, so thank you very much for this introduction and for having me here for this presentation, Petra. And so I suggest let's dive in. So Petra already introduced me. I have over 12 years in experience in the investment world. And yes, so I'm a single parent. It's now has been 5 years. I'm going to talk a little bit more about it. And I see the first time I'm using the beta, so I'm myself a little bit. I offer a step-by-step program to learn exactly how to and where to invest, how to plan for retirement, and make it fit the specifics of your international life, and looking at pension planning, tax matters, currencies, especially if you've been contributing and working and living in different countries. So now I'm not gonna move myself every time, but doing it again this time. And so I'm a Swiss national. I'm originally from the French-speaking part of Switzerland. I've been living in Zurich since 2014. And before that, as Petra mentioned, I've lived the expat life, and so worked in and lived in many different countries. I'm also the parent of a US citizen. My eldest son was born in New York. And so that comes with another set of challenges when it comes to investing. And I see Deborah nodding, so you're probably familiar with this, this situation. Okay, so moving, and I want to say you're in the right place if you are an expat and you lead an international oriented life in Europe, including the UK and Switzerland. You're very busy. You've already got way too much on your plate, and you don't really have time to spend ages learning about investing and dealing with your investments and your retirement planning. And maybe you're experiencing a change in priorities early on in your life. This whole thing, investing, retirement planning, was not really high on your radar, but now somehow, as we are all getting older, this topic is getting a little more important. And you might even feel a little bit behind. Most people do. You might feel you're in the dark on how to go about it and make it fit your specific situation. That's very normal. And maybe you want to stop worrying about, what about your money? What about high inflation that's going on right now? What is it going to look like for your retirement? And you want some peace of mind that you're doing what you need to do to ensure your financial security. On the other hand, I want to also mention that this is not a presentation, or in general, what I what I don't do is teaching about trading trick on how to buy and sell quickly and make, quick wins and stuff like that. This is not what I'm about. I'm really more about strategic long-term planning and long-term investing. And also it's often some people come to me when it's a little bit late, in the sense that they're already in big financial difficulties, and they hope that this will be the answer to their problem. So this is not the case. It's actually long-term investing and planning, and it's not like a quick fix whenever there is financial difficulties. I also like to mention that. All right. Want to say stay tuned until the end, because I'm going to mention a few platforms where you can get started. There are several. There are a lot that are really bad, and there are more and more that are actually quite good. And I'm going to touch on a few of them. And I would like to see. So we are 18. I think we have a poll for that, to see if you're an expat or not. I don't know if I think we can launch the poll somehow.
Yeah, I've already been sending out the questions.
Okay, perfect. Yeah, all right. Okay, so in the chat that also works well. Okay, so we have Anita in Geneva, who's been an expat since 2005. We have Gibran in Dubai. Hello. We have Amanda, who's a US citizen in Germany. We have Deborah in Israel, also, who has US citizenship. Then we have Isabelle, Brazilian citizen in Germany. So a nice crowd of expats. So this is really great. Okay, perfect. So you're familiar with the challenges of managing personal finances across countries, currencies, etc. So yeah, I think it's I'm really happy then that I'm here, because this is going to be very relevant for you. Okay, so now let's talk about the problem. So we have a lot of well-educated, mostly women in here attending this presentation, and you have a well-educated, a good job, but not investing, or investing very little, or maybe just not diversifying. In the case that you receive shares from your employers, that's very typical in the pharma sector or in the Google-ish kind of companies. And so then, but why is investing so important? Well, for all the things that we know, as women, we are at a disadvantage financially, typically paid less, promoted less, taking parental leave, part-time work, adapting to our husband's career. That was my case. I was always very career-oriented. I always wanted to have a full-blown career. At the same time, I was adapting my career to my husband's career, which meant sometimes it was good for him. I mean, we moved when it was really good for him and his pay, which was not necessarily the most logical moves for me. So these situations are very common. And so with that, what happens is that across the Western world, women retire with 40% less in pension capital at retirement, okay? So 40%, it's a lot, and it's very consistent. And that is it's really common, even if you kind of do everything right, getting a good education, working and everything, but just the way the system works, the way the society works, and in particular, the way pension systems work, they don't really work well for women, okay? And actually, it works even less well for expats, because these systems have been designed for people who lived their entire life in one single country, okay? And so to make things worse, women live on average 5 years longer than men. So basically, we have less, much less, but we need more. So how does that work out? And then, like I mentioned, expats are less protected by the retirement system, because it's very hard to qualify for benefits, retirement benefits, when you spend a few years in a country, then you move to another one. You have all these rules of how many years you need to have worked and contributed to a country to qualify for anything, right? And so that's why investing is the only way expat women can achieve financial security, okay? Because it's very common, and it's little talked about, but it's very common for women to get into financial difficulties later in life. And it will get even more so because of the aging of the population, the structural issues in pension systems. So generally, actually did a live video earlier today where I was saying, generally, the fact that pension systems are getting more and more into difficulties because of the aging of the population, combined with the fact that women are at a disadvantage in general in the pension systems. And on top of that, the pension systems don't work well for expats. So it's really kind of a very risky play when you are a woman who is living the expat life or did so in the past or plan to do that in the future. And I think I have, yeah. Okay, now I want to give a few more words about my story because it kind of illustrates this whole dynamic. So I have 2 college degrees and I always wanted a rewarding career that would give me financial independence. And if I flash back to 2012, I was following my husband around the world for his career. At that time, we were in New York. And that meant that my own career and earnings were like a roller coaster. And after the birth of our first son, combining a rewarding career and family responsibilities and adapting to his career became a real challenge. And at that time, I kind of knew I needed to sort out my personal finances and invest to grow my money, but I was so overworked, I just could not make it a priority. I could not find the time. I was just too exhausted. And then something terrible happened. So a few years later, when we were back in Switzerland, my husband had a road accident and he died pretty much on the spot. So as you can imagine, it was a very big shock. It was very sudden. It was very unexpected. At that time, I was pregnant with our second child. So it was the drama that you can imagine. It was very, very hard for me. It was very hard for our oldest son, who was 5 at this time. It was hard for our family. My husband was an only child, so it was very hard for his parents. So it was like this whole disaster that you can imagine. And the reason I really want to bring it up is because these also had very important financial complications or consequences, because all of a sudden my husband's large income was gone. All of a sudden I became a single parent, a single mom, and I had to support and pay for childcare in Switzerland, where it's very expensive for 2 young kids. And because we had lived the expat life around the world, we receive reduced survivor benefits. And so, fortunately, this difficult situation doesn't happen to most people. However, what happens to everybody is getting old and retiring at some point. And these benefits, these survivor benefits, for me as a widow and for my kids as orphans, they come from the retirement system. They come from the same place, and it's the same rules to qualify for them. Okay. And so early on in my life, I was confronted with what it means when you've been living the expat life, and now all of a sudden it's, you kind of need these benefits, but somehow it's hard, you don't really qualify or you get them much lower than you would if you had lived your entire life in the same country, because it's just, the way it works. As an expat, you're not so well protected. Okay. And so, let me check. And so that's why I really, of course, went then on a journey to reevaluate my financial situation, make changes. And also, instead of just investing on a professional basis or investing just because on my private account, but earlier when I was investing on my private account, it was more like I was trying to make more money. It was not so strategic and articulate, and I was not using it as a way to plan for retirement and as a way to achieve financial security. And that's why now I go about it completely differently. And now, so I have an investment and retirement plan that works for my specific situation as a former expat. I have implemented it and I stick to it. I've moved my money to a couple of cost-effective investment platforms, and I have a system in place to invest automatically every month. And thanks to my investment setup, my money is steadily growing over time at an average annual rate of 6% plus. So these are average, this is an average rate of return. Now, of course, in the last few years, the returns have been much higher than that, but on average, that's what we can expect. And I invest in alignment with my values. This is also a very important topic to me. And these are gender equality and climate action, and it just feels right. So now we have another poll. It would be great if you could tap in the chat if you invest, if you already invest. So either not at all or just a little bit, or yes, you are investing, you've been investing for a while. All right.
We have a couple answers. We've got a couple answers. Have started a Sparplan. Others a third pillar and company shares and property. Many are saying just a little bit and not at all.
Yes. Okay. All right. So that's very common. And I also see Lydia who say yes, but until now I'm in minus. Okay. So this is not as bad as you might think. Okay. Especially if you're investing in the right places, the right way. And, depending on when you started investing, since the end of last year, the stock market is down. It's just cyclicality. And so if you're in minus and you didn't start investing many years ago, then this is just normal. It's part of the game. But anyway, just wanted to drop that one, and now we can move on. Okay, Lydia. Yeah, if you only started last year, don't worry. It's much less problematic than what you might think. Okay. All right. So now let's move on to rule number 1. Don't lose money by investing for the long term. Okay. And so looking at what might be holding you back is thinking that, investing is too risky. I don't know enough, so I'll mess it up and lose my money. And I know so many people who lost money on the stock market. You might have heard these terrible stories and you're like, nah, this is not for me. It's way too risky. And so what I want to say about that is that on average, the stock market has experienced a decline or a crash or a contraction, whatever you want to call it, on average every 3 years over the last 100 years. Okay. So this, what we're experiencing now with the stock market being down, is just business as usual. No. Now, obviously, if you read when you just started investing, maybe last year or so, like Lydia, and you're like, for you, it seems like, it's impacting you a lot because you see your money in minus and you're like, oh my God, was this really a good decision? And also, if you look at the financial news, the newspapers, they like to make headlines or say, trillions have been lost, 50% decline for this stock, whatever, they need to sell news and they want to have flashy titles. But when you're an experienced investor, when you know how it works, you know that this is just business as usual. On average, there is a decline every 3 years. Sometimes it's longer than 3 years, sometimes it's shorter, but on average, it's just what happens with the stock market. And in spite of that, the long-term returns always seem to be 9 to 10% as kind of like pure returns on average every year, even accounting for all the crashes. And it's 9 to 10% as a pure return, but once you can remove like the taxes that you need to pay and some fees for investing and etc., then you get to approximately 6.5. If you kind of the 6% is already kind of having removed inflation. If you add inflation, you would get easily to 8%, but that's giving you an idea of how that looks like. Okay? And so that's why when it comes to investing and the risks of investing, rather than thinking about how you feel about risk, especially if you have to choose investment strategy, really risk is not about how you feel about risk, is really about how much time you have. Okay, if you have a long time until retirement and even beyond, then you can take more risk, because on average, the research shows that you get this approximately 6.5% on average when you invest for the long term, and that even if you have all these crashes. But then if you invest for the short term, let's say anything less than 5 years, the chances you're going to be on the wrong side of a stock market cycle is very high. Okay, because there is on average a stock market crash every 3 years. So if you invest for the short term, then yes, it's very risky, because you never know when the crash is going to happen. It will certainly happen. You just don't know when. Okay, so really risk when it comes to investing is about time, is not about how you feel about it. Okay, and the best way to minimize the risk is to invest for the long term, because when you invest for, I always say 10 years is the best, because then you way past the cyclicality. Okay, and we're going to look into that. So now let's look at invest for at least 10 years to benefit from compounding. And now we are beyond the risk aspect. We are looking about the returns aspects and the growth of your portfolio. So you're going to get what I mean in a second. So basically, what might be holding you back? It's thinking things like, now is not the right time to invest because the stock market is going down, because I'm changing job, because I'm getting married, because I'm getting divorced, because I'm having a child, I'm buying an apartment, I'm moving to another country. There is always some kind of reasons why we think it's not the right time to invest. Either it's because of what's happening in the stock market, or often we think it's too high and we want to wait. And when it's going down, we're afraid it's going to go down more, right? So at the end of and then the cycle repeats itself. Then we think, now it's too high again, right? And then we're 10 years later. And in terms of the personal aspects, there are always some kind of like reasons why now is not the right time in your life, right? And this is an issue because of the magic of compounding, which is actually a mathematical formula that, so the formal explanation is that you get a return on the amount you initially invest, but also on the accumulated earnings of previous periods. So I like to illustrate it in this way. So let's say you invest now a certain amount. Let's say you invest, I don't know, 1,000, 10,000 or whatever. The amount is irrelevant. And then 1 year from now, you're going to get a dividend on that amount you will have invested now. Okay. And then the year later, you will get a dividend again on the amount you invested, and you're going to start getting a dividend on the dividend of the first year. And then the year after, you start getting a dividend on the dividend of the dividends, etc., etc., etc. And then in the first few years, this looks like, this is peanuts. It's a few bucks, few $100 here and there, and it looks like nothing. But as of 10 years, it really accelerates. And that's what you see here on this slide. You know, the difference between, I'm going to move myself a little bit here. The difference between saving money, in this case, it's investing 15,000 and then 500 per month for 40 years. You know, you can change the numbers. Just the visual is going to look the same. Okay. The difference in the first 10 years is very little. Okay. except that these are here average returns. In reality, it's going up, down, and you're having a heart attack half the time, right? When you don't really know how it works, right? And so a lot of people, they give up way too soon, before the 10 years. Either the stock market is crashing, they panic, and then they sell, and they're like, oh my God, I'm never doing that again. Or they feel terrible, but they don't sell. And as soon as it goes up again, they're like, they sell, and they're like, oh, at least I didn't lose anything, okay? And then the reality is that actually most people don't stay the course. They don't stay for the 10 years, the minimum of 10 years it takes for compounding to really start working for them, which means that it's not only you hoping the stock market is going to go up. No, it's really this like dividends, this new money that is like being reinvested and earning new dividends and etc. And that it starts working for you and you start really reaping the benefits as of 10 years. Okay. And that's just mathematical. Okay. And then if you see for 40 years now, a lot of us, wish we started when we were like 20 or 25. And for most people, that's not the case. But here you see what it means. The longer you invest, the faster your portfolio is growing because of this compounding effect. Okay. And then one thing that I want to tell you, if you are in your 40s or even in your 50s and you are like thinking, now I'm too late. What I want to say is that most people think that they're going to invest, and then when they come to retirement, they sell everything and they start spending the money. Whereas, and actually it's not the way it works when you know how to go about it. It's that when you get close to retirement, you start adjusting your portfolio risk profile. And then from retirement onwards, you start withdrawing a specific amount of it every year, but your money keep being invested and working for you, and typically until you die, and even beyond, because the idea is that at the end, there's still money in your portfolio. Okay, so I'm mentioning that because even if you're a little bit, you feel like, oh, I'm too old now, I should have started earlier. It's not the case. You're going to live a long life. So you have a lot of time in front of you to benefit from compounding. Okay. Now, I want to talk about Roberta, the worst investor in the world, okay, to illustrate that point. So it's not a real person, it's not a real story, but someone once calculated what would have happened if someone had invested always at the worst possible time, right before a big stock market crash. So here we have the story of Roberta, who started investing with all her savings, $6,000, when she was 22 years old, and worst timing ever. Right after that, the stock market declined by 50%. Okay, she was like, oh my God, this was the worst idea ever. What was I thinking? So she stops investing, but she doesn't sell anything. Okay, and then 15 years later, when she's 37, she's like, okay, you know what? I'm going to give it another try. She invests all her savings, 46,000, and then right after that, bad luck, the stock market crashes again. And then again when she's 49, and then again when she's 57. And over the course of her life, she only invested at the top of the market at the worst possible time. Okay, in total, she invested 184,000, and yet she retired in 2013 with 1.1 million. Okay, so she invested 184,000 at the worst possible times, and she retired with 1.1 million. Okay, so this is to illustrate that, especially for example, for Lydia, you're like, oh, I should have waited, this was the bad time. And it's to illustrate that waiting for the right time is irrelevant. The best you can do is to start as soon as possible so that your money has time to compound for as long as possible. And this is what happened here. She invested when she was very young, 6,000 that, yes, lost in value right after that. They decreased by 50% right after that. But then they were compounding for 40 years for her up until she retired. And that really translated, and that really grew her portfolio dramatically. So the timing is, there is this quote that is, it's not timing the market that works, it's time in the market that counts. Okay. All right. Now, rule number 3. So this, what I just told you, it works. It's math, but it works if you keep fees low. Okay. And let's look at this now. So basically, what might be holding you back is to think that 2% is insignificant in terms of fees. I don't even think about it. Maybe you don't even look at the fees. Maybe you don't even consider them, or you look at the footnotes or whatever, and it says 0.5%, 0.25%, whatever. It doesn't make sense for you. It looks like small percentages and you just don't think of it. Or you're like, my money is safer with a renowned bank, even if they charge more. Or it's okay for banks to charge fees because they are specialists and I know nothing about investing. So with that, for the few of you who are already investing a little bit, maybe if you could type in the chat, in what kind of investments do you have? Do you have a typical fund from the bank? Do you have some kind of life insurance policy? Or do you invest on a trading platforms? Do you have a German savings plan? Or whatever kind of investments that you have, that would be helpful. So, for example, we have Isabelli who says invested a little bit. Lydia, I'm not sure what was your what are your investments? Then we have sometimes from Anita. So maybe like third pillar, Ayala, okay. And company shares, okay, sounds good. Then, okay, Adriana on the German Sparplan on ETF, so that's typically good. No fee US investment platforms, okay. Life insurance, okay, investment in startups, company shares, okay, Anita. Lydia, trading platform and third pillar, okay, good. All right, so thanks for that, for sharing that. Sparplan, Anika, okay, some company shares with my bank. Okay, sounds good. Okay, so the thing is, fees really matter. 2% here, 1% there doesn't sound like a lot, but it will eat up to half your money, and actually more of the money you should end up with over several decades. Okay, it works the same as compounding, actually. At the beginning, it's peanuts, but the longer you invest, the more it's really eating basically your portfolio. And here we see the same example as before. And so we have, the first investment is an investment in an ETF with a globally diversified ETF with a fee of 0.20%. You can find ETFs with lower fees. Many have higher fees. But here, in Europe, 0.20% for globally diversified ETF is pretty, much the norm. And so you see now the next line is investing with a traditional bank. It could be, here Lloyds Bank, but it could be whatever, UBS, Credit Suisse in Switzerland. It can be, the typical Commerzbank or whatever in Germany, etc. And here I gave them, with this calculation, there is a fee of 1.5%, but actually I'm very nice to them because I did a case study in my program for one of my program participants who had received a very attractive, what looked like a very interesting proposal from UBS to invest in a sustainable fund, and it looked like really, really interesting. And then once we digged into the fees, and we had to ask, I had her asking for additional documentation because they would say typically, it's everything is included is in this 1.2% or whatever. And then, but when you read the fine print, it would say, except this and this and this, which is available in a different document, right? So we did the digging, and then at the end of the day, the total fee was in excess of 3.5%, okay? And we're not even sure we captured everything, okay? So it's just to show you, they might tell you it's all included in 1%, in a 1% fee or 1.5% fee, but actually it's very, very likely not the case, okay? And then if you invest with an insurance company, this is really where you have the most fees, because they charge a lot of fees because of the way they operate. They also charge you fees for the risk that they insure for you. And so if you need to insure a risk, the risk of dying, like I have a life insurance policy, which is only insuring me in case I die. Okay, the premium is very low because if I don't die, I don't get anything at all. And that's not what and all I want is that in case I die, my children are protected because I'm the only parent now. Okay. And so if you need that kind of protection, then okay, you do it, but you only insure that risk. If you're looking at an investment to grow your money for retirement, then choosing an life insurance policy is really not a good idea because the fees are very high. And the worst of it is that actually usually when you sign for like 20 years or 25 years or 30 years, and you cannot get out of it without losing a lot of money. So in the US, actually, these life insurance policies are illegal because they are so detrimental for the people who sign them. They only work out for the insurance company and the actual person who got the bonus because they sold it to you. All right, so let me move again. All right, so now there are two ways to invest at a lower cost. So you can invest in low-cost investment products, things like ETFs and index funds. I'm going to touch on that in a second. You can invest directly in shares and bonds, but it's not necessarily practical. It's time-consuming. You have some emotional issues of like buying and selling the right companies, etc. And it's harder to get a diversified portfolio. But what you want to make sure is not to invest through an insurance policy and not to invest in an expensive fund by a traditional bank, okay? And instead, choose, and then also in terms, so it's not only the product, it's also the provider. So look for low-cost online trading platforms where you have to place the transactions yourself and build a portfolio yourself. And the alternative to that is a low-cost robo-advisor, which is basically they will build the portfolio for you, and then the robo part is going to automatically invest your contribution in this portfolio of ETFs that will have been built up for you according to your profile. Okay, and avoid traditional financial institutions like banks and insurance companies. All right. And so an ETF, what is that? So I saw that a few of you already invest in ETFs, which is great. So for those who don't know what, I mean, you might have heard that word, but maybe just to explain again what it is. So it's basically a fund, a low-cost fund where the portfolio represents the components of a market index. So one of the very famous index is the S&P 500, which basically is a portfolio or a basket or a portfolio of the 500 largest companies listed on the stock market in the US. Okay, and so an ETF tracking the S&P 500 is basically a fund that includes these 500 companies. It's automatically, and so when you invest in that ETF, your money is invested automatically to reflect the composition of this index. And because nobody's analyzing the stock market and, is it a good time to buy, sell, choosing the company, which one is the right one, which one should we sell, which one should we buy, blah, blah. So nobody's doing that. No portfolio management team, no research team, no traders, no, it's just you invest in these 500 largest companies listed in the US, or you have other index funds, which are global index funds of, you could have 4,000 companies in there, just proportionally where all the regions in the world are represented. And so you just invest in that. And because you don't need to, nobody needs to do crazy amount of works to invest this way, they have a very low cost attached to it. And what is really interesting is that one study after the other shows that over the long term, and that's for 10 years or more, low cost investments such as ETFs have a higher performance than traditional active investments. Okay. And so if you talk to someone from the financial sector, they will go at great lengths to tell you that, no, but we are protecting you because if the stock market goes down, we're going to buy more bonds and sell some stocks. And then, this kind of things. Or like, yeah, but, we have the analysis, we make sure we protect your money and whatever. They will go at great lengths to explain you why their fund is better than an ETF. But the facts remain. Then one study after the other says the same, that index investing, ETF investments have a better performance than the vast majority, the vast majorities of funds on an annual basis, and in the long term, pretty much of every actively managed fund. Okay, and so what this means is that the banks, with all the efforts that they are doing, they are not able to generate a return that's higher enough to compensate for the fees that they need to charge to have all these people and all this analysis and all this work being done. No. So basically it's pointless, right? You're better off with a simple, well-diversified global portfolio of ETFs, and nothing crazy is going around it, and your performance is higher. Okay. So now I have here a real life example that I like to share. It's not statistically relevant or anything, but it's a good anecdote to illustrate how it works. So basically, when I moved back to Switzerland, then after a while, I invested in 2015 in a 3A pillar account that I had at UBS, because they made me that account. When I came back, I opened all my bank accounts at UBS, and they opened also a 3A pillar. And then at some point I was like, I have to do my taxes. Let me see my 3A pillar. Okay, I'm just going to save on taxes, and I put it there. Okay. And then in 2018, I transferred it to VIAC, which is a low-cost platform for the 3A pillar investing in ETFs. Okay. And so up until 2021, so from 2015 to 2018, 3 years, my portfolio at UBS generated a total return of 1.5%, not per year, in total for the 3 years. And these were very good years in the stock market. Okay, it's not that it was bad years, it was very good years. And then from 2018 to 2021, the money that I'd invested in the stock market, in the ETFs, in the VIAC portfolio, generated a total return of 34.71%. Okay, and these were also good years on average in the stock market. Okay, so this is not statistically relevant. Is it really comparable? It's a short period of time. But it's just to illustrate that when your money is invested in a high fee environment, it just cannot grow, because any return that you get is eaten by the fees, which means not only the return is taken away from you, but on top of that, it's not being reinvested in the portfolio. So it's not generating more money for you, further down the line. All right. So that was that. Now, let's move on to how to get started as soon as possible. Okay. So what's typically holding us back is to not know where to start, what are the good places, not knowing where to go, who to trust, etc. Or very, very common, not to have time. I don't have time to start and manage my investments. A lot of people have this image that when you invest in the stock market, you have to watch the market all the time with your screens and buy and sell. And a lot of people, myself included, I'm like, oh my God, I'm way too busy and I so don't feel like doing that. Or some people think, actually, I don't have enough money saved up now. First, I need to save a lot of money. Now, some people think you need 20,000 to start. Some people think you need 100,000 to start. And this is actually not true. It's quite the opposite. The earlier you start with the smallest amounts, the better it is for you over time, but that's another topic. Anyways, let's go to one way you can invest quite fast in a low-cost environment is with an online robo-advisor, because as I mentioned before, you can invest, the company will makes you fill in a questionnaire so that they can build a portfolio of ETFs that fit and create a strategy that fits your profile. And once this is done, you can have automatic payment to that investment account, and the money is automatically invested in your portfolio of ETFs. And you can have sustainable portfolios with several of the robo-advisors. This is very low cost because they're not trying to, make money, trade, buying, selling. And it's also very user-friendly and transparent. And so you go online on the Robo's website, you fill in the online questionnaires about your profile, and then it's very quick. Typically, they verify your identity with some kind of application. It takes like 4 minutes. And then a day later or two, you get an email with your new investment account, IBAN. Then you can wire the minimum required, choose you if you want a sustainability strategy or a regular strategy, and then you start scheduling automatic transfers to your account on a monthly basis, and you're done. Okay, so you can invest like this and have a very good portfolio, and you can get started very quickly, and it doesn't take you much or any time to kind of maintain it. Okay, and now I often get this. I mean, now with COVID, people are more used to be online, I guess. So maybe a little bit less, but there is still this question. Is it safe to invest online? Is it safe to give my money to a robot? Are these like startups? What do they do with my money, etc.? And so actually, when you invest with a robot advisor, your money is not online. It's not even with the robot company or the team. All right. What they do is that they put in place the process to open an account in your name. So it's your own account at a bank. In Switzerland, it's typically Saxo Bank. It could be Credit Suisse. In other countries, it's different, the different local banks. So you have an account there in your own name. The robo company doesn't have it. They are just telling the bank based on their algorithm and automation systems how the money has to be invested. And they get their small fee as compensation, as a payment. Okay, so it's not like they're gonna run with your money. It's not like your money is online. It's not like they can disappear, or they have your money and somehow they disappear. No, your money is in a bank account. If it happens that the robo-advisor company closed down, it actually happened to me once a few years ago. Then they say, well, so our business was not successful, we are closing down, and now the bank is asking where they should sell you, what they should do with your portfolio. Do you want to keep it? Or sometimes they say, they don't want to keep you there, so they're asking you to confirm. They can send the money back to the account where you originally send the money from. Okay, or you can give another account, right? So it's not like your money is online. That's the point I want to make. All right. So here are a few of these robots. Okay. And so it was VIAC for the trade pillar that I mentioned, True Wealth, Selma. These are good ones for Switzerland. Yova is specialized in sustainability. It's available in Switzerland and in Germany. In the UK, we have ETF Matic, Nutmeg. There are more. In Germany, there are Query. In Germany, there are plenty. Not so many with sustainability options, actually, but there are plenty. And then there are more. And they're all a little bit similar, but a little bit different. They work a little bit the same, but they're a bit different. And they have different minimum amounts. They have different ways of doing a little bit of the same. Okay. And if you live in Switzerland, Germany, UK, you are very well served with a lot of options. If you lived in other countries, you have less options. But this is changing. So when I started looking really at this a few years ago, there were not so many good options serving places like Italy, Spain, France. But now more and more, a lot, the good platform starts operating and offering portfolios and their services in also other European countries. Okay, so almost there. Quick recap. Invest for at least 10 years to minimize the risk and grow your money thanks to compounding. Minimize the fees through low-cost investing like ETFs, low-cost platform providers. And the easiest and fastest way to start is with an online robo-advisor. All right. And now I would like to I have a message. We have some time before. Okay. All right. So obviously there are a bit more to learn about investing, and especially when it comes to planning for retirement. If you're an expat, and how to determine how much you should invest, when will you have enough to retire, how to diversify from company shares, which ETFs to choose. There are thousands of them. They all kind of look the same, but they're a bit different and they have cryptic names. What about bonds, shares, real estate, gold, in what proportions, etc., etc. So there is a little bit more to that topic. And so if you want to learn more about it, I invite you to get an easy start with my free email course. This is really easy. This is like 6 emails over the course of 6 days, and this topic is going to stay a little bit with you longer than this 1 hour than we're spending together. So Andreas shared the link in the chat, so feel free to sign up for that. It's free. And then, as I mentioned, I have my program, which is a fully fledged program where we look how to invest and where, really regarding all the specificity of the different platforms, and really looking in more details how to invest the best possible way. And then the critical component of the program is really looking at the other aspects. What about your pensions, your taxes, your currencies, your accounts? What about your spouse, your kids? This whole kind of picture, and bringing that into your kind of long-term retirement and investment planning. And we have so we have a program with lessons, we have Q&A calls, we have resources, the whole thing. Anyways, we do have a waiting list for this program. So if you have any interest to learn more about it, there's also the link shared in the chat. You can get on the waiting list, and then we can send you some more information. And when the time comes, and if you find it's a good fit, we'd love to get you in the program. So yeah, so we have the modules. I think in the interest of time, I will skip that, the Q&A calls. My sister Fanny, who is a CPA, is doing that with me, where we take the time to answer the questions and prepare all the information. And the tools and templates. We have a special training for Americans on what investing means for your taxes. Filings, with, as you know, is a complicated matter. We actually have a very detailed section about this because my son is American. I lived in the US, so I'm very sensitive about that. So if you're American, this is like the only place where you can find good information, honestly, because it's very, very difficult to figure it out as an American, unless you have zillions and a lot of lawyers and whatever. Okay, we have a Facebook group. So that's that. And with that, okay, I have more than 700 people have taken the program. So we have a lot of reviews and a lot of testimonials. Yeah, so who is a good fit? It's for residents in the Europe, UK, and Switzerland. It's for expat, international people, people who have money to invest, because it's meant to be very practical and hands-on and doing it as you go. And it's for people looking to invest for the long term. All right, and that's that. So I'm looking forward to answer a few questions now.
Amazing, Aysha. It was really, really entertaining. I really loved it very, very much. We have 5 minutes left, and I see Anita has a question. Could you just have a very short question so that she...
Hello. No, I'm just clapping. It was great.
Oh,
thank you.
Clapping, not a question. Andrea, I guess you have collected the questions.
Yeah, we do have a couple questions. I mean, you touched on it briefly, but it'd be great to go back over it. There's a question asking how you select the investments, the companies for your portfolio.
Okay, so I used to, when I didn't know any better, I loved investing, an investment professional, and I invested in a lot of companies that I believed in for the long term. And I went a little bit overboard with this. And at some point I had about 100 companies in my portfolios. It was unmanageable. There was no strategic, planning about it. And it took me so much time to manage. It was a disaster. Okay. And now I took the complete different route, which is also what the research says is best, is to have a very simple portfolio of ETFs. Okay, there are even ways you can even have like one all-in-one ETF. Okay, and so what I've really learned by experience, in addition to looking at all the research, and is really that unlike what we think if we want to do it good, and if we have a lot of money or more and more money or whatever, people who have a lot of money, they have a very complicated portfolio. And actually the people who are having the best performance are people who have a very simple portfolio. So that's why I really encourage you to consider that, and to really keep to build a simple portfolio of ETFs with 1, 2, 3, 4 ETFs. And then how to select that? There is so there are like maybe by now there must be like 7,000 or 8,000 different kind of ETFs, and many of them are doing the same. They are tracking the S&P 500 index. They are tracking a global index. So many are the same, except they are offered by different companies. So iShares is a company, BlackRock offering them. You have UBS offering them. You have X-Trackers. You have so many different brands of ETFs, and a lot of them offer the same, mostly, except they have different specificities. Some of them are reinvesting the dividend automatically, some are not. The fees obviously are different. So they have some different specificities. And one way to select them is to go on a website that is called justetf.com. And there you can put different criterias, and they'll give you, and you can kind of search through them. Now, to really make sense of all those that kind of look the same, but they don't, and you're not really sure what it is, well, that's a little bit my sauce. We have a whole section about this in the program, where we look at every item, so that and then walking through all the, how you actually select that, and why they are so different, so you can be confident you've selected the right one. But you can already go on Just ETF and play with that and see how far you get with that.
Thank you. Anita was asking, how high is inflation again on average?
Yeah, so inflation is a very big topic, especially now. So over the last 40 years or so, 30, 40 years, inflation across the Western world was quite low. Okay. And by low, meaning, so in a place like Switzerland, we had about 0.5%. In Europe, it was between 1% and 2%. In the US, would be between 2% and 5%. And that doesn't sound like much, but that's already, if you don't invest and you save, it's eating you. But like, if you have 2% inflation over 30 years, and you've only saved money instead of investing it, the inflation would have decreased the value of your saving by almost 50%. 50. Okay, so the impact is and that's only with 2% of inflation. Okay, which is the target most companies have, by the way. This is an entire other topic. So inflation is another reason why saving money is a road to zero. It's not an option, right? We need to invest to protect the money from inflation. And right now, because of different factors, including the war in Ukraine, but also very specifically because of all the money that has been injected in economies worldwide because of COVID, basically, then the inflation is very high, going as high as 6, 7, 8, 9%. So it's really, really decreasing the value of your savings. Now, it's not going to be, I don't see the future, clearly, nobody does, but it's not going to be like 8% for 30 years, okay, on average. No, it's going to, at some point, it's going to start going down. But it's really to illustrate that, inflation is a really big problem. So saving money is not an option. That's for sure. It's not, you should only save money to have like emergency money in case you need it, but your actual savings should be invested.
Hey, Aysha, I think this is the best sentence to stop with. Saving money is not an option. Yeah. So if you want to invest and invest with Aysha, I think she gave a very, very good example how she's doing it. It was very, very entertaining, Aysha. I really have to thank you that
You're very welcome. I'm glad you liked it.
To Role Model Rebels. And for all of you, this session is going to be recorded, as you know, and you can find the recordings within the next days in the members area. And having said that, Aysha, again, thank you very much. And for all of you who joined, also thank you very much for your time. Have a wonderful evening. Enjoy the summer night, at least here in Switzerland in the mountains. And Aysha, again, thank you very, very much.
You're very welcome. Thank you for having me, and I wish you all a very nice evening. Make sure to sign up for the free email course so this topic stays with you.
Thank you so much.
Longer.
Bye, Aysha. Bye-bye.
All right.